Tencent stock has dropped 40% from its all-time highs, with its market cap falling $400 billion. The catalyst for this drop is a number of regulatory events that have taken place since early 2021. In this video, we'll be analyzing 4 sets of regulations and how it impacts Tencent's business and stock valuation. Let's start with the regulation of Tencent's gaming business. On August 3, 2021, a state media article was posted criticizing Tencent's gaming business and its potential negative effects on minor players. The article then called for additional regulation of the gaming industry in order to address these concerns. After the article was posted, Tencent stock fell 10% in a single day, shedding billions of dollars of market cap, as investors grew concerned about the impact of additional gaming regulation. Let's take a closer look at what impact this could have on Tencent's business. Pulling up Tencent's 2020 annual report, Tencent actually provides the amount of gaming revenue that it generates from minors. In the fourth quarter of 2020, minors accounted for only 6% of its China online game gross receipts. Relatively speaking, this is a very small portion of Tencent's overall gaming revenues. Looking at Tencent's total gaming revenue from 2020, Tencent generated 156.1 billion RMB from the segment. Doing a rough calculation, if we multiply this number by 6%, this results in about 9.4 billion RMB in revenue coming from minor players. If we look at this number compared to Tencent's total revenue of 482 billion RMB in 2020, we can see that it makes up less than 2% of Tencent's total revenue. Even assuming a complete impairment of Tencent's minor player gaming revenue, which is unlikely, this does not have a significant impact on their business. As a result, a 10% drop in Tencent's stock price appears to be an overreaction by the market. An important point to emphasize about this gaming regulation is that this is not Tencent's first time dealing with this. In 2018, Tencent's gaming business faced significant headwinds as China increased its concerns regarding video games and their impact on society. As a result, Tencent's pipeline of games saw a freeze on approvals and increased restrictions on how much minor players could spend time on video games. The block of Tencent's game approvals directly impacted the growth of Tencent's gaming business, with the gaming business experiencing negative year-over-year growth following the game approval freeze, despite posting strong double-digit growth before. Following this gaming regulation, Tencent stock traded sideways for about 2 years, as regulatory overhang and investor uncertainty placed downward pressure on the stock price. That said, Tencent has a strong track record of high regulatory compliance, as seen with how they dealt with 2018, but also how swiftly they responded to the state media regarding their gaming business. In response to this article, Tencent announced that it would introduce further restrictions on its gaming business, including reducing the amount of time minors can play, as well as placing restrictions on in-game spending. Since Tencent's 2018 gaming regulation experience, the company has worked to continue diversifying its revenues to reduce the company's reliance on gaming. Tencent has especially focused on investing and growing its financial technology businesses, which brings us into the second set of regulation, fintech. In 2020, regulators halted the $300 billion IPO of Alibaba's fintech and payments business, Ant Group. This event sparked a number of regulatory measures on the fintech industry, which includes significant regulation of credit lending as well as reduced payment fees. Ant Group, Tencent, and a number of other leading fintech businesses experienced strong growth and profits from their credit lending or microloan businesses. However, fintech hasn't experienced the same level of oversight as compared to traditional banks or lending institutions. This has raised concerns about potential over-leveraging and credit risk of these fintech companies, since banks are the ones that hold a significant part of the financial risk. However, when it comes to the regulation of Tencent's credit lending business, Tencent has demonstrated strong compliance with regulators relative to some of its competitors such as Alibaba. Tencent's management has emphasized that they seek to work with existing financial institutions such as traditional banks instead of focusing on disrupting them. Rather than optimizing for profits, the focus on maintaining a high level of compliance and cooperation will likely benefit Tencent in the long term, especially given the amount of oversight in the financial sector. In addition to the credit lending business, Tencent's payments business is also experiencing headwinds. In 2021, officials met to persuade financial institutions to reduce payment fees in order to help small businesses. Some of these measures include potentially reducing online payment fees by 10%, waiving cash withdrawal fees, and lowering bank card processing fees. To estimate the impact of this fee reduction, let's take a look at the worst case scenario where Tencent would have to cut fees by 10%. While Tencent doesn't disclose the exact amount of payments revenue they generate from their fintech and business services segment, let's estimate that 50% of these revenues are from payments. A 10% fee reduction in 64 billion RMB of payment revenues would result in a roughly 6 billion RMB decline in revenues and profits, assuming this loss falls directly to the bottom line. This would potentially lead to an estimated 1% decrease in total revenues and 5% decrease in total profits from 2020. While the financial impact of this fee reduction is not extremely significant, these decreased fees do contribute to increased regulatory overhang. In turn, this can contribute towards a multiple derating of Tencent's payment business as investors become more uncertain about regulation and the long-term earnings growth of the segment. The third major set of regulation is about exclusivity agreements. This regulation is primarily targeted at Alibaba and Tencent, who have been known to close off their ecosystems. Previously, Alibaba and Tencent did not offer each other's payment methods on their respective platforms, and Tencent was also reported to have been blocking competitor links on WeChat, as well as not offering many of Alibaba's businesses as WeChat mini programs. By opening up its ecosystem, Tencent will be subject to more competition by the likes of Alibaba and ByteDance, but Tencent's payments will benefit from now having access to Alibaba's ecosystem. The exclusivity agreement regulation also impacted Tencent Music, Tencent's music streaming platform and China's leading music streaming service. In July 2021, the State Administration of Market Regulation ruled for Tencent Music to give up its exclusive rights to music labels. In previous years, Tencent established exclusive music rights with the major record labels, including Universal Music Group, Sony Music Group, and Warner Music Group. Tencent Music would then sub-license these rights out to other competitors. By losing these exclusive music rights, this will likely make Tencent Music more prone to competition, such as ByteDance. Aside from a relatively small fine of 500,000 yuan, or $77,000, this regulation on Tencent Music has not directly impacted Tencent's bottom line. That said, the most important aspect of this regulation is that some of Tencent's exclusive partnerships with their investments may be at risk. Tencent is known for having one of the best tech investment portfolios in the world. Some of their successful investments include Meituan, JD.com, Pinduoduo, Didi, and many more. When Tencent invests in these companies, it's usually a win-win for both Tencent and the investee. While Tencent receives the opportunity to invest, the company receives access to Tencent's 1.2 billion monthly active user WeChat ecosystem, which serves as a major source of user traffic for these companies. For example, investees like Pinduoduo have their own WeChat mini programs, which serve as a major traffic funnel for their e-commerce and group buying operations. In return, Tencent's investees have agreed to use some of Tencent's B2B services, such as Tencent Cloud, which have been a significant growth engine for Tencent. Without these exclusivity agreements, Tencent's investees may choose to use other alternatives to Tencent's B2B services, which could impact this segment's growth. That said, the financial impacts of this exclusivity agreement regulation will likely pan out over a longer time horizon. The fourth set of regulation is about China's private education industry, which includes edtech, tutoring, and online courses. In July 2021, regulators announced a new set of rules regarding the private education industry. This included measures such as restricting tutoring on weekends and preventing education companies from raising outside capital. As a result, the fundamentals of these businesses were negatively impacted, as their profits will be limited significantly moving forward. These education companies were large advertising spenders on Tencent's ad platforms, and with the industry now being reined in, this will have a negative impact on Tencent's ad business. When this regulation came out, Tencent stock fell 10%. To estimate the effect of education regulation on Tencent's business, we can add up the sales and marketing expenses of some of the leading public education and tutoring companies in 2020. This results in about $2.6 billion in sales and marketing spend. We also need to add non-public education sales and marketing spend as well. For a rough estimate, let's assume that this number is similar to public ad spend and added on. If we estimate that about 40% of the education industry sales and marketing spend goes towards Tencent's advertising platforms, this would result in about $2.1 billion of ad spend for Tencent. Comparing this number to Tencent's total ad revenue in 2020 after converting to dollars, this makes up about 17% of Tencent's ad revenue. Assuming that Tencent's entire education ad revenue is impaired, this would result in about a 3% decline in Tencent's total revenue in 2020. While this is a notable impact to Tencent's ad business, compared to the 10% drop in Tencent stock, it would appear that the sell-off is overdone. Now we'll discuss the valuation of Tencent stock. Tencent is a complex business with a lot of moving parts, the most notable being the company's large investment portfolio. Let's do some napkin math on Tencent's valuation. In the first quarter of 2021, Tencent stated that the fair value of its public investments was about $210 billion. After applying a 30% holding company discount for tax and illiquidity considerations, this results in an estimated fair value of about $150 billion for the investment portfolio. After backing this portfolio out of Tencent's current market cap of around $550 billion, this implies the core business is worth roughly $400 billion while trading on a forward earnings multiple of less than 20 times. Tencent's core business includes a collection of high-quality assets including WeChat, its messaging, payments, and e-commerce ecosystem with 1.2 billion users, the world's largest gaming business, and a suite of leading B2B services like Tencent Cloud. Not only do each of these business segments have high growth potential, but they are also led by a top management team that has demonstrated a strong track record of capital allocation. As for regulation, keep in mind that China's goal isn't to take down their national champions, but instead plan for the long term, which involves oversight of businesses that have large societal impact. When it comes to Tencent, focusing on the long term over short-term stock price volatility is key. With a cheap valuation, a strong set of businesses, and a stellar track record of capital allocation, Tencent's long-term risk-reward looks attractive despite the regulatory headwinds. Subscribe to stay updated for new videos, and comment down below what you think about Tencent. Also, if you're interested in learning more about investing in China tech, you can sign up for the free newsletter in the description below.